Welcome back, it's Seth here. Today I want to discuss something that not a lot of people are talking about, but could be a direct killer of the US economy. And that is Japan and their bond yield. Yep, you heard me right, it's Japan and their bond yield. You may be thinking, why Japan? Japan is on the other side of the world. How does Japan have such a big impact on the US economy? So in this video, I'll walk you through how Japan has a huge impact on the US economy and how this may affect you. However, before I do dive deeper into this video, if you can, please hit the like button down below, and if you haven't subscribed, please subscribe to help grow our channel. Now that you hit the like button, let's dive in. So to start off, let me give you a little bit of background on Japan and their interest rate. So Japan has had a really big hand in keeping the US economy really strong, and this goes all the way back to the 1990s. You see, in 1992, Japan experienced a terrible economic downturn, where their asset bubble collapsed. The Japanese saw the real estate prices drop significantly and their equities flat out collapsed. For Japan, this was called the lost decades, where so much value was lost from the assets and there was no growth for the next 3 decades. Over 3 decades, Japan has not seen a lot of growth in wages, no real GDP growth, and next to no inflation. What pushed Japan into this no growth territory was the mindset that the people of Japan were developing. With low wage growth and an aging population, the people of Japan were developing a deflationary mindset, where consumers and businesses expected the price of goods to either stay the same or decrease in the future. So this caused the average Japanese to delay the purchase that they wanted to make or to go and invest. So to tackle this issue, the Bank of Japan did what any other central bank or federal bank would do. They dropped interest rates, and they dropped these interest rates down to 0%, and then even below 0%. But when Bank of Japan realized that this wouldn't be enough, they implemented something called a yield curve control. And what a yield curve control is, when a bank wants to target its interest rates in the long run, it will buy and sell as many bonds as it needs to hit that target rate in the future. So by implementing this yield curve control, the Bank of Japan was able to keep its long-term bonds at around 0%, while short-term bonds were just a bit below 0%, around negative 0.1%. So now that the government was keeping rates around 0%, this causes a lot of issues for investors, especially the ones that are holding a lot of cash, because now they have 2 options. The first option is that they accept a 0% return and keep the cash that they have on their hands, meaning they'll get no return at all on the cash they're holding. Or the second option is to move their money out of Japan into another country to get some returns. And well, what most investors chose to do was the second option. They decided to take their money and put it into another country where they can get a return. And for the Japanese, the favorite country to invest in became the US, and Japan became the largest holders of US treasuries. So Japanese hold the largest amount of US debt. And here's how it really made sense for the Japanese to do this. So for Japanese investors, they would go to the bank and borrow Japanese yen, and they would borrow this money at 0%. So essentially, it's free money. They would take the Japanese yen, convert it into the US dollar, and then buy US treasuries. So for the Japanese investors, if the treasuries were paying 4%, then the return would be 4% minus any fees and costs that they incurred. So in the end, they would take a return on their money. So this process has been done by the Japanese for many decades. But now, here's what's changing in Japan. So the assumption has always been that Japan will probably keep its interest rates around 0%. However, that changed in March of 2024, when the Bank of Japan actually raised their interest rates for the first time, and ending the yield curve control policy. Also, after the first rate, the Bank of Japan raised the interest rates again in July of 2024, which had a huge impact on the Japanese economy, but also had a trickle effect on the US. During the second time that the Bank of Japan raised its interest, the Nikkei index fell almost 12% in one day, and then the S&P 500 followed by a drop of 3.1%. You may already start seeing the patterns and why this happened. And if you don't, well, this rise in interest rates caused 2 big concerns. So the first one being, now that the average investor cannot borrow money for free. They have to pay interest on the money that they're borrowing. So borrowing has now gotten expensive. Also, now the second concern is that the hedging risk is now more expensive. So that 4% interest that you're getting from the US Treasuries, well, that doesn't really start looking that good anymore. So all that money that was flowing from Japan into the US, well, that slowly starts to dwindle, and less money leaves Japan and enters the US. This concept of money moving back into Japan from the US is called repatriation. And this is one of the biggest threats in the current modern economy. So now you probably want to know, well, how do these rising rates in Japan really impact the US and the average individual? Well, like I said before, Japan isn't just like any other country. Japan is the biggest holders of US assets. For years, Japanese pension funds, banks, and insurance companies have been buying US stocks and bonds because Japan paid them next to nothing. Now, with the rising rates in Japan, why take the currency risk and the volatility that US has experienced in the past few years when you can get safer returns at home? So as the interest rates keep rising in Japan, less and less Japanese will move their money into the US and buy US assets. The money that would have gone into the US goes right back to Japan. And there's even a risk that these Japanese investors may start selling out their US assets. This would have a result by reducing demand for US assets, which has been there for decades, leading to more volatility in the tech sector, and growth stocks would get hit harder than other sectors. So that fear of a correction or crash becomes more and more likely to occur. Now, this impact was more for individuals that are heavily invested in the stock market. But what about the average American? Well, this is when things get really serious. So here's the thing. Japan is the largest holders of US treasuries. So now if Japan pulls back on buying bonds, or even worse, starts selling the bonds that they have, this causes the demand for bonds to fall. And if the US wants to attract investors to purchase their bonds, well, to do this, they're going to have to raise their bond yield. And now if you're thinking, if the bond yield does rise, how does this impact me? Well, I hate to break it to you, but the bond yield is the foundation for all borrowing costs. So when that bond yield rises, well, this has a huge impact on the mortgage that you want to get to purchase your new home. The higher the bond yield, the higher the interest rate you'll get on that mortgage that you need. So that new car that you wanted to buy on a car loan, well, that car loan got a lot more expensive than before. Any business financing you need to operate your business or grow your business, well, be ready to pay way more than before. And any personal loans that you need to pay your urgent expenses, well, that loan is going to cost you a lot more than before. Lastly, the US has a very large amount of debt that they're holding, and this debt requires interest to be paid by the US. So the higher the interest rate, the more interest that the government will need to pay. So in turn, this means that the US government will have to cut some of its spending. And this could impact the future infrastructures that are needed to keep the country going. It could impact social spending and just the overall growth of the US. So these rising rates in Japan are not a great thing for the average American, at least in the short term. Now, here's my thoughts and opinions on this. Personally, I'm not going to lie to you, this type of uncertainty is really hard to ignore. When you start to hear about global money flows shifting, rising interest rates in Japan, and the potential pressure on the US economy, it can feel like something big is changing. But here's how I look at it. Even with all this, I still believe in the long-term growth in the United States. And the reason is quite simple. The US continues to lead in real economic growth due to innovation, technology, and capital. Some of the biggest and most influential companies are based in the US. And they're spending billions and billions of dollars every single year to become more efficient, to produce better products, and to shape the future. This kind of innovation doesn't disappear because of short-term shifts in global interest rates. Now, what does this mean? Will the US always outperform other markets? And the answer to that question is pretty simple: no. There absolutely will be periods where other countries will outperform the US economy. There will be periods where other countries and markets will do a lot better than the US. That's just how global cycles work. But in the long term, the US has consistently stayed the strongest economy. And I don't think this is going to change anytime soon. So yes, Japan raising its interest rates can cause volatility. It could lead to higher borrowing costs. And it could pressure the markets in the short term. But you have to remember that volatility is not the same thing as a long-term decline. When it comes to investing, that distinction is everything. Because if you're just focused on the short term, well, that's how you get shaken out. But if you stay focused on the long term, well, that's how real wealth is made. So I decided to make this video to inform you on the global shifts that we're currently seeing so that you can make the right decision for yourself. So if you guys really enjoyed this video, please stay tuned for future videos. And until next time, remember to keep investing.